All right, we are live.
Hey, we are live for the webinar with Jay Soloff from Investor Alley. There you have Dmitry Pargamanik, the creator.
Hello, everybody. Good evening.
And founder of Market Chameleon and really the king chameleon. A lot of the ideas you see on Market Chameleon come out of that great mind of his. And he's been a good friend and a partner of mine for, Jesus, how long, Dmitry? 20,
I don't know.
Years?
Yeah.
A lifetime ago.
Yeah, definitely.
So Jay, thanks for doing this webinar with us. I know the chameleons who are joining are going to be super excited to hear what you have to say. Jay was a floor trader on the CBOE. He's now you've been a portfolio manager. What else have you done, Jay? You've got an MBA. You were an economics major undergrad. I think
I sold paint for a while in Sherwin-Williams.
Paint did you sell it door to door?
No, I actually worked in a Sherwin-Williams. So I was a lot of mixing and dropping off paint at clients, actually. But that's how I paid for college. And making sandwiches at like 3 a.m. at Jimmy John's. That was another one.
That's awesome.
I caddied. Yeah, I used to caddy. The thing is that, I'm not that big. So a lot of caddies carry 2 bags. They would only let me carry 1. They said I wasn't big enough. So I would only make half of the usual.
That's a ripoff. Well, just so everyone, I've got you both beat. I sold baskets store to store when I got out of college. That was my first job. Yep.
Oh, really? Baskets. That's interesting. I didn't even know that.
Yep, and I didn't know you were a caddy. You learn things every day on this show. So anyways, a few ground rules of today's show. You know what? Today with Jay, he likes to get, if you have a question relevant to the topic Jay's discussing at the moment, just put it in the chat. Also put in the chat if you can't hear us. I've asked. We only had one person answer. It sounds like everyone can hear us. And any questions that Jay is off topic or something you want to answer at the end, put in the Q&A down at the bottom. Again, thanks for joining us. I'm going to go through actually, Dmitry, you'll read the disclaimer. I'll display it. How's that?
Sure, no problem. Yep. So, hello, everybody. And just keep in mind, we are not registered investment advisors. We're not broker dealers. We're not telling you what to do. If you need professional advice, then you should seek, professional investment advisor or call your broker. There's the disclaimer right there. We're just sharing ideas. And I think with that, everybody, is good.
Yeah. Now, if you like that disclaimer, Dmitry and I actually do a morning show every morning. Jay, I don't know if you're aware of this. We go live right before 9 o'clock every day on our YouTube channel and talk about the pre-market. And I'll tell you, Dmitry every day has some unique insight into what's going on. So that's something anyone who's not involved with Market Chameleon may want to know. And with that, I think Jay is going to talk about volatility today. Is that correct, Jay?
We're going to talk about volatility. In terms of the pre-market show, I usually don't get dressed until about like noon. So I don't know if I could actually attend. Quarantine has kind of changed my life a little bit, but I've seen that. I need to check out that show. I saw that's pretty recent, right? The pre-market show?
We're 5 episodes in. Tomorrow morning will be the 6th.
Nice. Yep. All right. I'll check it out.
Something new and exciting every day. That's what the market brings us. And, it's been a good show. We get a nice response. And for all you late risers, it sits on the YouTube channel forever. So it will be.
It never goes out of style.
Well, what I wore yesterday was out of style. Believe me. All right, let's get started.
All right, so we're gonna talk a lot about volatility. Let me share my screen here first, and then we're going to be doing this from, all right, so can everyone see this all right? Hopefully.
I know that well. That's the chameleon.
Yes. We're going to be doing this for Market Chameleon, of course. It's a wonderful tool. It's what I use for virtually all of my analysis. So we're gonna spend our time in here, but I'm going to do a lot of sort of explanation that I'll be able to show a little bit, but you'll kind of have to follow what I'm talking about. So feel free to jump in with questions if you have them. Will let me know if there's anything. So, all right. So that being said, what I want to do is I want to talk a little bit about what volatility is, and then I want to talk about why there are trading opportunities because of it. And then finally, we're going to go over some potential ways to trade volatility. Now, each of those could easily be a webinar, and the last one in particular could probably be about 50 webinars. So we're gonna hit a lot of points, depending on, how much you love math and financial engineering. You can get really far down the rabbit hole with this stuff. So I may not talk about anything you're familiar with, or I may talk about stuff that is that is quite basic, because volatility really is a huge, it's a huge field, right? When you get into professional options trading, it's really what you see the most focus on. And there are books and white papers and so much written about it. So, you could really delve into it. So I'm going to try to cover some of the more popular topics, some of the stuff that's a little bit easier to understand. But really you could delve into this, quite a bit. So for instance, we're going to start with what volatility is. And really there are two types of volatility. There's implied volatility, which is the stuff that generally you hear about when you hear about, market volatility is high. You usually talk about implied volatility in terms like something like the VIX, right? You see the VIX quoted on CNBC or whatever it might be. The VIX is a measure of S&P 500 implied volatility. And all that means is it's what the market expects volatility to be over the next, generally it's 30 days, right? Over the next 30 days, does the market expect, do option traders expect the S&P 500 to be volatile? And let me show you why that. Here, let me bring up sorry, my video is blocking my symbol thing here. Let me move that. All right, so we're going to go with SPY S&P 500 ETF. This is the most liquid contract in the world, essentially. So it's a good one to use to gauge the market. But what I want to show you here with the options are, just looking at the options that expire at the end of the week. What implied volatility is, and why it's important, is if you look at the price of an S&P 500 option. So the calls, at the money calls at the end of the week are trading for, 235, about 250 for the puts, right? So if I were to take, let's say, this put price and throw it into an option pricing equation. So Black-Scholes would be the one. So the Black-Scholes model, you may have heard of it. That's what revolutionized the trading of options back in the 70s, because it allowed the market to come up with more realistic pricing for options. So generally you have this equation, and it takes into account the underlying price and the strike, and if there's a dividend, if interest rates are important, which they're not right now, and then volatility. You throw that into an equation and you get a price, right? Well, volatility is the one thing that no one knows for sure what it is, and a lot of people have different opinions on it. So if you want to figure out what the market thinks volatility is, all you have to do is work backwards, right? We already have these prices. They're set by the market makers or the specialists, right? So we have these prices. We know what the specialists think the market is worth. So if we throw this 250 back into Black-Scholes and reverse calculate it, we will get a volatility number. That is implied volatility, right? That's what the market is telling us that volatility is. And you can see here, Market Chameleon calculates it here for the bid and ask. So it's about 17% right now. That's the implied volatility. So that 30-day volatility, we expect the options to have the 17% volatility, which is a annualized standard deviation, right? It's 17% would be the year sort of movement, but we're looking at it over 30 days. So it's a little confusing, but basically the higher the number, right, the more you expect the underlying to move. 17 is actually pretty low compared to where we have been recently. It's about the six, as you can see here on Market Chameleon, it's about the 60th percentile. So it's not it's not super low, right? We're over the 50% mark, but a lot lower than it was. Of course, we had a crash right in March. So implied volatility got, actually, let's look at how high implied volatility got. We can go here and I'll come back to this chart in a minute. I just wanted to see, looks like we got up as high as 79%. So we're down to 17%. So obviously, and you can see here how far we've come. And I'm going to come back to this chart, so don't worry about it just yet. But the idea is that implied volatility has really come down quite a bit. That's actually what we're looking at the options that expire at the end of the week. We probably want to compare more apples to apples. So if we look at the options that expire in about a month, let's look at the August 20. This is the August monthly. This is probably a more accurate depiction. It's probably closer to about 20%, right? So we have close to 20% implied volatility. And if you look up here, that's what the 30-day implied volatility, that's what Market Chameleon is showing. It's showing that's generally the month out is kind of what we want to use as our implied volatility, right? So, but what that number is really saying is that we expect the S&P 500 to move in a range up or down 20% over the course of the year. So that's a pretty big number. If you think about 325 and 20% is what, 60, 65, 65 points, right? You expect it to. Now, the thing about volatility is it doesn't necessarily have to go up 65 or down 65. It could go up 30 and then down 30 and then, so implied volatility means movement. It doesn't necessarily mean direction, but that's what we're saying here. So again, the higher the number, the more you expect this number to move. All right. So that's kind of our predictive number. Now, what we want to look at is the other thing we want to look at is historical volatility or realized volatility. That's the second part. And that is looking backwards. So here, if we go to this stock volatility tab, we have SPY historical stock volatility. And what this does is it shows the rolling 20-day volatility. So the last 20 days, and every day it's moves up 20 days, right? It's like a moving average, right? So rolling 20-day volatility. The most common one you see is as close to close. That means the price at the close of the day measured compared to the price of the close of the previous day, right? So closing prices, that's generally what you're looking at with historical volatility. However, unlike implied volatility, there are multiple ways to calculate historical volatility, which is why it's a little bit trickier measure, right? There are different ways to calculate it, and there's no right way to calculate it. Like, for instance, this green line is measuring historical volatility, taking into account the open price, the high, the low, and the close, right? So you could have a closing price, let's say at 325, the next day it could close at 325, and it would look like there's not a lot of volatility. But what happens if somewhere in between SPY got up to 350 and then came back down to 325? That measure would not take that into account. So a lot of times this number might be higher, open, high, low, close. It might be higher if the underlying instrument is active during trading hours, right? It might mean this volatility. So that's one way. That's one way to measure. You can also measure it from open to close or from close to open or something like that. That'll take into account the after hours, right? So there's a lot of different ways to calculate it. You have after hours, you have highs and lows, you have different components that you can use to measure historical stock volatility. None of them are particularly correct, right? They're all a little bit different ways of measuring it. And a lot of professionals will look at all of them, right? They'll say, all right, well, this one's really active during the day, doesn't do much after hours, or this one does most of its moves after hours, but it's pretty quiet during the day. So the point is that there's not one right way. Generally, you see close to close. If you look at if you were to pull up a site, beyond Market Chameleon and find historical volatility number, most likely, unless it's stated otherwise, it's going to be close to close. So, and there's nothing wrong with that. It's a perfectly reasonable measurement, but sometimes you want to break it down, get a little bit more granular. And that's one great thing about Market Chameleon is you can look at that. You can look at this OHLC and kind of see the difference. You might say, man, I really feel like the SPY volatility, historical volatility is low. It feels like it's been a lot more active. And then you pull it up and say, wow, actually it has been a lot more active if you take into account where it's trading during the trading day. So, all right, so you have these numbers. So now you have two important numbers: implied volatility, which is what the market thinks is going to happen in 30 days, right? And then you have historical volatility, which is what has happened over, let's say the last 20 days, right? So now you have two numbers that are essentially apples to apples, not entirely, but close enough, right? Maybe an apple and I don't know. Will, what's something that's close to an apple? I'd say orange is kind of maybe an orange and a tangerine or something. Right? There's not, Apple doesn't have a really close counterpart. So, so you have oranges and tangerines, which you can compare relatively well. So let's go back to that chart that I was looking at, implied volatility. And I do a lot of my analysis from this particular chart. I think it's really useful. For the time being, I'm going to turn off options volume. Some people, like to use options volume. I'm going to turn it off just for this explanation. So we have this implied volatility, this 30-day implied volatility we've been talking about. The one that we saw during the crash got as high as 79 and now is trading around 20, right? You can see that 20 is still high compared to what it was before the crash, right? Where it rarely got as high as 20 over, much of the last year. And that's where this IV rank comes into play. You can see that, on a relative basis, 20 is pretty high. It's over, it's close to 60% of what it's been compared to the highest point, right? So, and you can see that visually. I instead of looking at the rank, if you're more of a visual person, you could just look at this chart and say, wow, yeah, obviously 20 is much higher than it was before the crash. Right, but it's not also anywhere near as high as it was during the crash, which of course makes sense, right? During the crash, you expect there to be huge swings, either falling further or recovering faster, right? You expect there to be big swings, so you would expect volatility to be high. Now we can add something like historical volatility, and Dmitry, correct me if I'm wrong, but this is the close to close that we're looking at for the purple line?
I believe it might be the open high low close.
Oh, okay, open high low close. Okay.
Yeah, I think it's the historical.
Okay, all right, even better. That's actually the one I prefer to use, even though you see close to close more often. I like the open high low close. I think it's a little bit more. A lot of people who don't trade after hours, don't really care too much about what happens after hours. They prefer to see what's going on during the day. So I like that one. But now you could see here that, now keep in mind, we're overlaying something that is looking at the last 20 days with something that's looking 30 days ahead, right? That's why it's comparing oranges to tangerines, right? And not oranges to oranges, because there is, you're forward looking and you're backward looking. So that, there is a different time frame. These don't necessarily need to, there might be a legitimate reason for them not to match up, right? So the key is finding situations where there's a big disparity between these, and you think that might be a trading opportunity, and that's not super easy, right? Now it's easier, I think, than picking stock direction, but it's not super easy. If it was super easy, then there wouldn't be an opportunity, right? It'd be arbitraged away. There'd be no opportunity, right? So, I mean, you have to have a thesis. I mean, there needs to be a reason behind your belief, right? So you might say that, so generally speaking, right, since the implied volatility is forward looking, you would expect that historical volatility will follow implied volatility. That I think most people are looking for the actual realized volatility to match kind of what is being predicted. But again, doesn't necessarily have to be that way. But looking at like the crash scenario, you can obviously see that implied volatility got significantly higher than what actually happened with movement. Now, there's a good reason for that, right? This was a period of crisis. You had also multiple hedge funds imploding, liquidation in the markets. There was a ton of stuff going on here. Credit markets froze up. People are willing to pay a premium for protection at that point. So you would expect this number to be higher. That's not necessarily out of whack. That doesn't mean there's not opportunity, right? But this is, if this behavior didn't look like this during the crash, then I would think something screwed up with the measurement, right? Because you would definitely expect option prices to be extremely high. So there's almost no way historical volatility is going to be higher than what's going on in option pricing during a price. When we actually go back and figure out what historical volatility was, it's not generally, ever going to be higher than implied volatility during a crisis. just because of the demand for options. But, maybe here is where your opportunity is, when you see that implied volatility dropped down pretty quick when things started to normalize, but, the market remained pretty volatile, for after that, right? It looks almost like traders got ahead of they were pretty quick to start selling options again or getting rid of hedges, even though the market still stayed pretty volatile for quite a bit while after that. So this might have been an opportunity where you're like, you know what? I think volatility is kind of cheap here. I think we might have another sell-off. I'm going to buy some options here, buy some volatility, right? And then maybe you cashed out here when there's a spike in June and the market sold off 6% in one day. Or, so that's a very basic, that's a very basic way of looking at it. But you can see here where disparities in implied and historical volatility might show you, where there's a trading opportunity. But you need to have an opinion, right? You don't just look at this and say, oh, wow, look at this huge gap. Well, sure, there's going to be some displacement because of what was going on, right? But I had a thesis here looking at this, and that was, yeah, implied volatility is definitely going to come down because this was a crisis, but really, should it come down this quickly? Should it really have fallen this quickly after we just saw, an actual stock market crash, something we haven't seen since 2008, right? Should it be? And I was like, no, I think this is probably at the very least, I was not going to short volatility. We didn't necessarily do a whole lot of volatility buying because it was still kind of expensive, but I was not shorting it. I am not going to short it. This is not a situation where I feel comfortable, and sure enough, we had multiple spikes, right? Now it's a little bit different, right? Now it's a situation where I might consider taking a short position of volatility. Now I'm not.
We got a question.
Yeah,
how
go ahead.
much that top day of 80 vol and SPY,
Mm-hmm.
was that the day that the Fed announced that they were going to step in with unlimited money supply, or was it the next day?
I think it was the next day. March 16th was the peak. It was a 10% down day. I think it was the next day that the Fed came in and said we were going to start buying. They're going to start buying it. I don't remember exactly when that they started buying LQD and HYG and some of these ETFs that trade corporate bonds just to make sure that the credit market started flowing. But that was definitely the key turning point. I don't know if this was exactly it. This might've been, I think they did something. It was just like a liquidity injection. And then later on they were buying the ETFs, and I don't remember the exact timing of that stuff, but that's one of the reasons why volatility went down so quickly. And that was also one of my reasons, like, okay, well, that's good. It's going to keep the credit market from freezing up, but it's not necessarily going to keep stocks from going down. And so that's why I thought this might've been an opportunity here for buying volatility.
Yeah, so, absolutely. We do have a question from Nick. He's asking, do you look at 3 or 5 year at all? I guess you've been mostly working with 1 year. He's just asking.
I'm mostly looking at 1 year. I mean, the thing is that, well, part of the problem is once you have a major dislocation, all this stuff looks like it's pretty close, right? It doesn't look like there's it's kind of funny. You look at this, I'm like, oh, there wasn't that much difference. Well, at the time there was. This probably would have been a really big, this sell-off on the December 24th in 2018 would have looked a lot more extreme had it not been for this crash. But no, I mean, I think the problem is with looking too long when it comes to volatility is that situations change, right? I mean, you can't compare a period where we're in the middle of a pandemic, with, the sell-off in February of 18, which was due to volatility ETFs coming undone, right? Very different situation. So yes, you could use it for sort of longer term data points if you're doing some kind of, research that you need to compare apples to apples. But I think when you're looking at implied and historical volatility, I think you want to kind of look at you want to look at the regime you're in, right? I think the regime we're in this year kind of goes from February when volatility started picking up to now. That's kind of the stuff I want to compare to.
Sounds like a good plan.
Yeah, nothing wrong with looking at longer term. I don't find it quite as useful, particularly when extreme things are happening in the market. Another thing you can do is also, instead of looking at versus historical, another thing I like to do is look at implied volatility versus its own 20-day rolling average, right? So you can kind of see, opportunities here, particularly more recently where, once implied volatility started coming down, all right, well, how's implied volatility compare to its, to where it's been over the last 20 days? Because I think you might have some different situations where some news item or something like that causes like a very temporary sort of dislocation, even in implied volatility itself. So there might just be an opportunity, or like, I think the options are a little cheaper, they're a little expensive. So that's yet another thing. You can look at implied volatilities average. You can look at historical volatility average. One of them I don't really use, but it is, you can look at historical volatility for the year. I don't look at it this too much, although you can see that if you were trying to predict where volatility was going to go to after the crash, realized volatility, this 252 moving average might have been a decent guide to tell you that it was going to come back down into the 20s, something along those lines. So, but anyways, again, while this stuff is happening real time, it's a lot harder to make that call. All right. So I think before we move on, any questions about this stuff that you're seeing, Will?
Well, we got the one question. There is one in the queue. Someone was asking, I don't know if you want to take a quick look at IV of a stock while you're on the IV.
Oh, sure.
Well, actually, it's a commodity. Someone was asking for Jay to look at the IV of GLD.
Yeah. And I think, so we'll look at GLD. One thing I was going to say actually real quick, and I'm not going to cover trading earnings in this particular webinar, but one thing about when you're looking at implied volatility for stocks that you need to realize, though, is that earnings almost always have an associated bump in implied volatility that happens prior to earnings because they expect there to be a move. You're not going to see that with an index ETF. So just something to be aware. A lot of times earnings moves are priced into options, so there may not be nearly as much opportunity as it looks when you're looking at that. You could always look, well, gee, I'm just going to sell implied volatility every time we get up here, and it's not that easy, right? That's something that's pretty much built into the pricing structure. But all right, but GLD is not. It's it covers gold, so there's obviously not earnings, but pretty much tracks what the index was doing, right? Because it's a defensive, it's a defensive instrument. So when things started to get in hairy, you saw the same thing. You saw gold moving a lot as well. So gold was kind of moving just as much as the index, not in performance terms, not in relative terms, right? Gold IV generally is a lot lower. You can see it's 14 and historical is about 10. It doesn't move nearly as much as the index in terms of like actual moves, but it kind of tracked. In fact, we can compare it right here. You can see that the shape of the moves was very similar, right? But gold itself is not as volatile as an index during tumultuous times because it's a defensive instrument. But you could see the moves were very similar to the market. So probably, there's probably an equal number of people who were thinking about buying puts as they were buying gold, right? So anyways, there's a lot of action going on there.
Here you're comparing the SPY vol to the GLD.
Yes. Yeah. This is comparing SPY to GLD. So, you could see that. You can see, that obviously it's a very close pattern, but with all the craziness in stocks, it got quite a bit higher. Where gold is a little safer here in terms of volatility. That this is a good reason here why you might consider gold as a defensive investment, right? Because even if it didn't perform, and it ended up performing just fine, but even if it didn't perform, you could see besides the dip here during the liquidation period, it's done really well. But even if you weren't concerned, even if you're less concerned about performance and more concerned about stability, you can see how much less volatile gold was than an index that covers 500 stocks, right? That's supposed to be more stable because it's diversified, but you can see where gold, and I am not, and I'll be the first to admit, I'm not a huge fan of precious metals as defensive, but you can see why it's useful as a defensive play. I mean, look how much less volatile it is. If you had a huge portfolio and you didn't want to see massive swings in your day-to-day P&L, then gold would have been a good investment during the crash, right? So thank you for asking about that, because that made a very good example. All right, so now the question is how do you actually trade volatility? And that's, I think that's that's the $1 million question, right? I mean, it's not. You can find opportunities to trade volatility, particularly during market crashes and things like that. There's obviously opportunities where you get this big disparity between historical and implied. And then, the question becomes is, how do I actually turn that into profit in my portfolio? And then I think that's the hard part, right? Because it's not cut and dry for the most part. And the easiest thing to do, though, is to trade the volatility exchange traded products, right? The stuff like VXX and we had TVIX, which is now gone away. Here, let me pull up. So VXX, if you're not familiar, is actually, let's go to the VXX.
As you're getting started with identifying volatility trades, you did have a question right before you started. What are the guidelines to be considered while trading IV? So just keep that in mind. And he's asking, which is all dependent on obviously what product you're going to trade IV in, but he's asking what is a good number, whatever that means.
Right.
But
I mean, and that's, and a good number to trade IV is tough, right? Because not only do you need to know kind of what has happened in the past, but you need to determine if the future is going to look anything like the past, right? So that's why I like to focus on market volatility. So something like the VIX, like the S&P 500, because that's a number that I watch all the time. So, and a lot of people watch the VIX. So you might be familiar with the VIX, it sits around 12, and it's when it gets up to 30 when things are really crazy, and it got up to 80 during the crash. That might be a number you're familiar with. So you might look at that and say, you know what, I think 12 is too low, or 80 is too high, or whatever it might be, right? Those are numbers that you look at all the time. Now, it's hard to just jump into a stock that you haven't been following and say, I really think volatility is too expensive here. You kind of, you obviously have to do your research, but it also helps to be familiar with the products you're trading. Again, the easiest way to do that is market volatility, because there's lots of ways to measure market volatility with VIX, and you can look at the ETFs that are based on VIX, like VXX, which trades the first two futures of VIX. And what's nice is that you don't have to worry about trading futures, right? This does it for you, right? So the other thing is that the calculation there is basically for them. When you're looking at VXX or you're looking at VIX, you're looking at essentially you're looking at market volatility, right? You're not trying to figure out, okay, well, is the volatility in Apple high or low, and what does that have to do? What does that have to do with earnings? Is it some other product announcement? What's going on? Now, you're looking at market volatility, right? You're looking at the big stuff going on. How is the pandemic impacting volatility? How is the presidential election impacting volatility? And you can look at VIX, which just trades futures and options. It doesn't actually trade. So you can look at that stuff, but if you actually want to trade it, you either need to trade futures or options on futures, or you come and you can, if you want to trade, if you don't want to trade that, so a lot of people don't want to have to worry about trading futures, then you can get in something like VXX. So it's a much easier way to trade it. Now, this could probably be a whole nother webinar, but VIX itself is not, when we were looking at SPY, we were looking at the implied volatility for the at the money options. So like that 325 call and put. VIX is a little bit more all encompassing measurement. It kind of includes, technically speaking, it's the price of a forward of a variance swap. So it's a pretty complex, how it's calculated is pretty complex, but what it does is it takes into account basically multiple options, like a strip of options. So some out of the money, some in the money. So it's a little bit more all encompassing than just looking at implied volatility for something like SPY. It should be in the ballpark, but not necessarily. So just if you end up doing your own research and you look at VIX and you're like, wow, why is VIX so different than SPY implied volatility? Is that an opportunity? Well, it might be, but they are different calculations. So, but VXX again is probably the most popular ETF that actually has options. TVIX doesn't have options, and now it's being delisted, or it is delisted, or it's on the pink sheet, so that's gone. I do happen to, yeah.
Someone's asking, is VXX the volatility of the vol?
No, no, it is not. Actually, that would be VVIX. It's not a tradable thing. VVIX. You can look up the volatility of the VIX. You can look it up. It is an index VVIX, but it's not a tradable thing, which would be kind of funny if you could trade, let's say, trade an option on VVIX, you'd be basically trading a fourth derivative of the S&P, the volatility of volatility, which is the volatility of options, which is a derivative of SPX. So no, but yeah, no, VXX is actually a combination of the first month future and the second month future for the VIX. Right, so it's a measure of short-term volatility. So the way to look at it is basically what near-term volatility, what you expect to happen, basically over the next month to roughly 30 days, right? So it's a good way to kind of easily trade volatility. It's a relatively pure way, not 100%, but there used to be a lot more choices in the volatility world. A lot of stuff kind of went away after the vol crash of February of 2018. However, I happen to know that there's some ETFs coming to the market. One's going to be an inverse of VXX called SVIX. The SEC has a deadline of, I think, September 16th to approve it. So unless they can find something dramatically wrong with it, then it should be approved in September. And that'll give you some more options, because there is SVXY, which is out there, which is an inverse of VXX, but it's only a 0.5. It's a half inverse. So it doesn't really move all that much. It's kind of the other one that has options is UVXY, which is a levered one. It's 1.5 times VXX. So TVIX was out there. That was 2 times VXX, but even when it did trade, it didn't have options. It was only the stock. UVXY does have options. That was another one submitted to the SEC, a double VXX, basically a double of VXX, 2 times VXX, that will have options. So there are a couple products coming that will make it easier to trade volatility. So, but looking at this stuff like, UVXY, you could see if you really were concerned about the pandemic, this might have been, something where you could get long, buy calls of UVXY, in February. This is actually a trade that I did. I was fortunate, although I got out probably too early, but I had started reading about, pandemic in China, and I had some people who knew quite a bit about it, and they were worried how it was going to impact the US. I actually had one of my services in UVXY before this. I think it went from like 11 to 23 or something.
Wait, you had early indicators on the problems in China? Well, thanks, Jay.
Sorry. Yeah.
Dmitry and I were running around with our heads cut off. Where was the heads up on that?
Yeah, well, that's, maybe for another Market Chameleon mug, I'll let you in on.
I do have my mask, I must say. It's crazy, because even if you had told me, I'd have been like, Jay, please, pandemic, you're out of your mind.
Well, no, and as good as that trade was, we got in at about 11 or 12 and got out at about 23. So it went all the way up to like 110. So it was far worse than I actually had imagined it. So but these are good ways to trade. And again, you can buy. So if you want to take a short position of volatility, you can buy puts on these. Market volatility, you can buy calls, you can use call spreads, you can use different strategies for actually trading it. This is the easiest way to get used to trading volatility, right? So whenever volatility gets to extreme levels, it does tend to mean revert a little bit more quickly than like a stock price. However, it also does show clustering properties. So it will, as you can see, hang out kind of at levels for a while. And then, and then when it gets high again, it's kind of clustered in this high, like it didn't immediately go back to, these levels down here. It's going to take a while to do that. But it does have these sort of mean reversion properties that make it a little bit easier to trade than stock direction. At least in my opinion, I've always felt it's easier to trade.
Do you trade? We have a question from himself, a legendary trader, Scott Larison, is asking, do you follow VXN, the NASDAQ fall?
I look at it on occasion. So if you're, if you this is one of the things I was going to touch on, but it's again, and you start to really get down the rabbit hole is you can look at relative volatility. So you could look at volatility between instruments. And one thing you might do is look at, S&P 500 volatility, as measured by the VIX, and then look at something like NASDAQ 100 volatility. I think that's NASDAQ 100 and not NASDAQ composite. Yeah. As measured by VXN. And then SIBO has another one. Actually, I think it is tradable with futures. What is it? RVX or something like that. That's Russell 2000 volatility. So you can actually, if you determine that there's opportunity between the indexes, that might be one way. And a simple way might be like, okay, I think NASDAQ volatility is too low and, S&P 500 volatility is too high, and I'm going to, buy one and sell the other, right? So the problem is that the only thing that's really liquid right now in terms of market volatility products are these S&P 500 run VXX, TVIX, soon to be replaced, UVXY, SVXY. These are the things that are tradable. They're all related to the S&P 500. Other volatility products have not gained traction. For a while, there was one you could trade Europe, the Europe version of VIX. It was EVIX, and I think that's now been delisted. I don't even know if it'll show up here. Yeah, it's not. Yeah, here it is. VSTOXX futures. This is the. It's delisted or soon will be delisted. So you could trade, you could pretty easily trade Europe versus VXX, but for whatever reason, it never really caught on. You can see it's stopped trading here. And that's an easy way to do some sort of relative volatility trading. The problem with doing relative volatility trading, like we were looking at GLD versus, and this was going to be the next point I was going to get into anyway. So thank you for the lead. But we were looking at GLD versus VXX, right? And we were looking at, or SPY, sorry, we were looking at SPY, which you could trade VXX as a proxy to SPY pretty well. And let's say you wanted to buy that GLD volatility and sell the SPY volatility. Well, that's a trade you could potentially do because you could buy a put, let's say VXX. The problem is, how do you buy volatility in GLD? Because there's not a VXX for GLD. There's not a VIX for GLD. Well, actually there is, but it's not tradable. It's on the SIBO. Can't remember what the symbol is, but off the top of my head. But there is a way to measure it. But to trade it, you'd actually have to trade the GLD options. Now with buying volatility, it's somewhat simple. You could buy the straddle. It's expensive, but you could do it. You're buying the call and put at the money. The problem comes when, all right, well, what if you want to sell volatility in GLD? And if you're a, retail trader, like me, like I'm a retail trader. Right? I'm not an institution. I'm a retail trader. Even if I, with 22 years experience trading options, if I wanted to sell a straddle, it'd be really difficult, right? It's unlimited risk. So you have to either have a ton of margin in your account. I mean, it's not an easy thing to do for a non-institutional trader to sell straddles, right? So then you have to think about, all right, well, maybe I want to do a butterfly or a condor or some other structure, but that's not exactly selling volatility either. So it starts to become hairy when you start to have to trade options to trade volatility instead of these, instead of the VXXs of the world. That's why I recommend, if you want to trade volatility, start with market volatility, because you have products that make it easy. VXX, UVXY, soon to be SVIX. Eventually there might be more tradable volatility indexes. The problem is the SEC is a little bit, they seem to be a little bit leery. After February 2018, a lot of people got hurt when XIV, that was the inverse of VXX. That thing crashed. It was poorly designed and it crashed. And a lot of retail traders got really hurt by that. So the SEC has been hesitant to add more stuff, which is unfortunate because they're really useful for trading. I love trading this stuff and I love putting my people into it, but it's not the, they are a little bit more complicated. So,
when you say put your people into it, Jay, you have a newsletter. Is it a short-term trade typically? Because I've always heard that holding these, and someone's asking that.
Yeah.
So it's that, holding some of these products long-term is notoriously a bad trade. Is it typically a shorter-term hold period for these trades?
Yeah, absolutely. For the most part, and again, this is another topic, but the way these things are designed is that they're not really meant for long-term holding. You could argue that maybe if you're going to set it and forget it for a year at a time, you could be short volatility since it tends to go down, but you could make that argument and I would listen to it. But in terms of tactical trades, you don't, generally a month is as long as I'll hold something like this, unless it's a hedge. And that was, one of the things I was going to mention. And again, there's so much we could talk about here that it's kind of hard to determine what path to go down. But VXX, something like this also could make a nice hedge, right? So particularly during volatile periods, you might want to have VXX calls, or maybe like a call spread, because it's not that expensive. Have a call spread in your account. If you're worried about stocks going down, it might be cheaper than having, let's say, index puts or something like that. So these also are really good ways to protect your portfolio. And depending on how you design the strategies, and I've been talking about options, but you could just buy the stock too, right? I mean, TVIX had $3 billion in assets under management and had no options, right? People were just buying or shorting that ETF or ETN, whatever it is. So yeah, you don't just have to trade the options. I'm obviously an option trader, so I look at the options on these things, but we have a long trade in VXX on now, just because I feel like, we're due for a little bit of a sell-off in the market. And I felt that a call spread was relatively cheap. So, that's the sort of trade I may get. I think a 2-week trade is going to be the max that we would hold it for. Questions or Dmitry, you haven't said much, so hopefully that means I know what I'm talking about, but anything you'd like to add?
That was pretty good. Well, I was going to ask you, what do you think about, we're coming up to an election in November, and how do you think, how would you prepare yourself as far as volatility goes? Do you think it'll be more volatile heading into election because there's uncertainty, with election, and, depends who wins, right? There could be a dramatic policy change, and with that uncertainty, would you be looking for implied volatility to come in, and maybe would that be an opportunity if volatility comes in to buy on a dip heading into the election? I know that we're also in the coronavirus, right? So anything can happen as well there. But what do you think about an event like that heading into an election?
Yeah, I mean, absolutely. And if you look at and I can't pull it up here, but if you look at the VIX term structure, you can see that the futures around the election, there's a big hump, right? It's like this line kind of going down, and then there's this big hump for the futures that expire over election. So the market is already priced in a significant premium for for the election. And I think if that premium comes down at all, I'm definitely a buyer of that. I think that, I think certainly this election in particular, there's so much at stake, right? I mean, there's just, so much in terms of policy and of course, all the various social issues going on, and there's a lot of stuff going on in this country that is sort of hinging on this election. So very much, I see volatility going up as if assuming that we're not already like, a land of zombies because of the pandemic, right? Assuming things are somewhat settled down, and that might also be right around the time a second wave hits during flu season. So it could be Armageddon. And so I definitely am more of a long vol person as we head into the election. On the other hand, assuming the pandemic is at least being somewhat predictable in how it's spreading at that point, after the election might be a good opportunity to sell volatility, right? So no matter who wins, because at least at that point, you'll have a certainty. You'll know, you'll have a better idea of what the policy changes may or may not be. You'll have some certainty in place. And if the pandemic is at least somewhat under control, then I would expect to see a lot of volatility selling. So I think I think there's various opportunities to get long volatility and get short volatility due to the election. Obviously, the wild card here is the pandemic. I mean, how bad is second wave going to get? What is the progress of vaccines? Are vaccines even going to, make a big difference? Or do they need to be tested? How quickly can they roll them out? Is another flu strain going to confuse the matter? I mean, there's like so much going on here, right? Not to mention, I'm not even mentioning the economic impact, right? I mean, a lot of things are occurring right now and that are based on, I think we have extra unemployment insurance possibly ending this weekend. You have, things like the loans to the companies and things like that will run out. So there's stuff that might be helping to sort of prop up the economic numbers that also might determine, even well before the election, that the economy may be a lot worse off than even we expect. So there's all these potential catalysts, which is really why I don't want to go short volatility, despite the fact that it continues to kind of drift downward. I'm really scared, even though the metrics are starting to say it's okay to short volatility.
Right. And Jay, like having said that, would it make sense then to do something like a time spread, right? So maybe buying the options that would cover the event to make sure that, heading into the event and covering the event, you're long those options, selling longer dated options, being short Vegas with anticipation that you'll get that gamma going into the event, but also capitalize on the eventual implied volatility crush or implied volatility once we get some certainty coming in. So would you say that a time spread or maybe a diagonal spread would be a good way to position yourself if having that view?
100%, I think it's a good idea. And I think the problem with that, again, comes into when you're doing a time spread that direction, where you're buying early and you're selling late, you have the issues with margin if you're a retail trader. And that's the issue that I always run across in my services when I want to do something in some of my products. Like when I want to do something like that, I essentially really can't do it. You could do a calendar or diagonal the other way, right? Where you're selling the front month and you're buying the back month, because your broker's all right with that, because the short part will expire before the long part. And so you're protected. But when you're doing it the other way, essentially you have unlimited risk. So you either need to have a pretty good margin, a pretty decent size margin account with your broker, or you need to, buy some options around that short, maybe do like a really big butterfly or something like that in order to protect your margin. But that's the issue I find with at least with my own experiences with having, having option products, is that there's not an easy way for retail traders to short volatility if it's not already in an ETF type format. So that, I think, that's restricted. But I mean, in terms of that strategy, 100%, that's what I would be doing. I mean, potentially you could do something with like the VIX options on futures, where you're buying a near term future or buying a call and then buying a put on a back month future. That's kind of a way to replicate it with the market. you could use VXZ here, which is the the mid part. Does have options on it. This is the mid part of the VIX curve, which again is not something we really had time to talk about term structure, but that's another thing. So there are ways kind of around it with market volatility, but when you get into, like if you wanted to do it with Apple, for instance, it would be quite a bit more difficult without, again, like I usually go into trading assuming that someone either doesn't have a big margin account or doesn't want to have a margin account. So that's how I kind of set things up. But certainly, I have more sort of advanced traders who can do naked short straddles and things like that. And if you're comfortable doing stuff like that, yeah, by all means, if you're comfortable hedging that stuff. But that tends to be sort of the wall that I hit when I'm doing strategies. Like, where does the margin requirement really get in the way of execution?
There you go. Jay, we have a bunch of questions. I'm going to try to get to them short. I know we're coming up on the hour. Someone's asking, what's Jay's VXX support level? So is there something that you use where you're like, if VXX gets to here, this is where I'm holding the line? Or are you not like that?
I will basically encourage everyone not to use any sort of technical analysis when it comes to looking at volatility, because it's not a price, right? I mean, it's not it's not a price like a stock price, right? It's more of a percentage, right? And it's a standard deviation, and it's a measure of liquidity. It doesn't mean the same thing as a stock price. However, that being said, there's nothing wrong with looking at, past prices and saying, this seems really high or really low. The problem is how you need to have a kind of a firmer grasp on how VXX is calculated using the first two futures to really kind of understand why it behaves the way it does. But there might be a level where you're like, what, given where we've been over the last 3 months, I think I'm at that level now. I thought 30 in VXX was kind of a point where we really would kind of be a floor for the short term. But I mean, that's for the short term. 30 means nothing. 3 months from now, 30 is going to mean nothing, right? So in the very short term, I might look at something like 30 and say that's kind of my floor that's why I decided to buy a call spread. But very short term on that, because things change quite a bit in the world of volatility.
Excellent. We have a question about, well, it's really about stock vol, but someone's using IBM as an example. Do you ever use IV to identify a potential move in the stock, either up or down? And he was using IBM as an example. I don't know if you want to look at the IBM IV, but that's the question we had.
Yeah. And when the answer is absolutely, that is another way that you can use, as a proxy, right? So another way you could potentially trade volatility is with stock direction, right? It's not, again, there is not 100%, it's not a one-to-one relationship per se, but if you look at implied volatility tends to go up as the stock goes down, as you can kind of see loosely just looking at the difference between the chart. Now the crash is an obvious example here, but as implied volatility goes up in IBM, it was going down. Typically, generally speaking, implied volatility is going to move opposite of stock direction. So if you do see implied volatility going up and it's not necessarily related to earnings, so you might see implied volatility going up well before earnings and the stock kind of staying stable, you might say, oh, well, that's an opportunity. I think if IBM is going to go down, volatility is going up, people are obviously buying puts or something like that. So there is that potential there. You can use direction as and vice versa, right? You might buy index calls if you think volatility is going down, because there is that inverse relationship. It's not perfect, but it's a decent proxy if you don't want to actually trade volatility or don't have access to it.
All right. We had a question from Paul who's asking, in your opinion, Jay, and I know this is only your opinion, is there a best way you look at for protecting yourself if you believe a market downturn's coming? I mean, I know you talked about getting the early feel for the coronavirus coming out of China and how you would, put on a trade in UVXY, I think it was, but spreads, holding short deltas, what do you look to do?
Yeah, the key is that, and the trick with hedging is that, it's always it's cheapest when you don't need it, right? So it's expensive when you need hedges, index puts, VXX calls, whatever it is. That's when they're expensive, right? So I mean, I try to have some sort of hedge on at all times in my portfolio, but it's not always practical, right? Because then when you have this whatever it is, this option or this inverse stock or whatever it might be that is fading away as everything else in your portfolio is doing well, it's a lot of people have trouble with that, and I get it, right? So I mean, I think that's why options are really great for hedging, because you can try to find a structure. Maybe it's a butterfly, or if you're more advanced, it's something like a butterfly or a back spread, or some kind of ratio spread where you might be able to keep your costs low. But even just simple vertical spread, call spreads in VXX, put spreads in SPY, or QQQ or something like that. Those are good ways. I like to, if I'm even remotely worried about the market selling off, I like to have at least something like that in my account. But you can always just have like an allocation to things like gold and bonds and utilities, and that might be a reasonable hedge as well. So, there's lots of different ways to protect yourself. It's more of, is it going to be sort of a strategic thing, or is it going to be a tactical thing, right? So for tactical hedges, I think you want to use options as much as possible, because you can design that hedge to fit your own needs really well. If you're talking about more, long-term strategic hedging, then, having some kind of allocation to gold, or various bonds, or long volatility, that maybe somehow pays some kind of dividend or something like that. That's a good way.
Excellent. Well, we're over the hour now, but I'll leave with this one last question from Bruce Stewart, who's hung on for the entire hour. And he's asking you, this is for you personally, Jay, do you in your weekly newsletter do calls and puts only, or do you also do spreads?
The Options Floor Trader Pro, which is the base product, is only calls and puts. We have an upgrade that's Options Insider. I'll move into spreads, but I like for people to start with just calls and puts to get a feel for kind of how options move around, and before you get into spreads, because I think it's a good idea just to see how things like time decay and volatility impact your options before you confuse it with multiple options kind of tied together. But yeah, I mean, we kind of have different levels. So base product, which is just buying calls and puts, insiders, which gets in the spreads, other stuff for covered calls and that sort of thing. So, we kind of have run the gamut of different levels of trading.
Excellent. That was a great show, Jay. Dmitry, thanks for all the comments there, Dima.
Yep. Thank you, Jay. Thank you, guys. Thank you, everybody, for joining us.
Yeah. Join us for tomorrow's show. We have always a great, exciting morning show. And there were a lot of questions about, and I didn't want to go off topic today. We have so much more. We have to have a round 2 maybe in another month.
Yeah, for sure.
I mean, we didn't get into, you're right, term structure, or there were questions about skew,
yep.
reverse skew and GLD and SLV, comparing GLD to SLV. I mean, it was a lot of different stuff, but there were a lot of questions, D, about using Market Chameleon to take advantage of volatility crush during earnings season. I didn't want to get into that right now, but maybe we'll talk about it tomorrow morning if anyone wants to join us.
Sure.
Jay, thanks so much. It was great, as always.
Yeah. Thank you very much.
Thanks, guys. Appreciate it.
Very good.
Thanks, everyone, for joining us. Have a great night and a great trading day tomorrow. Have a safe week, everybody. Bye.
Good night, everyone.
Bye.